Hello, thanks for watching this week ahead video today. The lovely Kelly O'Byrne is missing in action, unfortunately, but please don't click the stop button just yet, because we do have some interesting topics to cover, including whether the dip in stock markets is finished, some of the huge drops in British companies' shares, Brexit and the renewed weakness in the British pound, and scope for gold to break that 1,300 per ounce level, as well as running through top earnings releases and the economic calendar for this week. We'll start with our highlights from the scheduled corporate results. On Monday, we have McGraw-Hill Education, SolarCity and T-Mobile USA. On Tuesday, Bunzl and Best Buy. On Wednesday, HSS Hire, Petrofac, Barnes & Noble and Box. On Thursday, Jimmy Choo, Ladbrokes Coral, Dollar General and Jamba. And on Friday, Nomura. Now, moving on to the economic calendar, we have picked out what we think could be the most market-moving releases. So in chronological order, we have UK lending and consumer credit, US GDP, US ADP unemployment, EIA crude oil inventories, China non-manufacturing PMI, Eurozone unemployment, Eurozone CPI, US personal spending, Eurozone manufacturing and services PMIs, and last but not least, of course, US non-farm payrolls and average earnings. So let's talk about that dip we've been seeing in stock indices. The thing to remember is that this bull market is really resilient. Technically, it's significant that we've seen some big down weeks, but we've not taken our big levels of support yet. For me, in the UK 100, big support is at the 7,300, then 7,100 levels. In the DAX, it's 12K, and on Wall Street, it's 21,200. Fundamentally, there hasn't been much justification for the sell-off. Fears over conflict with North Korea are justifiable, but seem to have blown over. On the positive side, earnings growth has been good, and central banks are treading very carefully about tightening monetary policy, so investors are still willing to take on risk. I did also want to quickly comment on some of those huge drops in British shares last week. I'm talking about Provident Financial, WPP and Dixon's Carphone, all of which gave profit warnings and saw their shares tank by over 10%. The way I'd read this is that investors currently have a very low tolerance for disappointment. So this makes sense because the FTSE 100 is near record highs and with an above average price earnings ratio. So basically, only the top performing stocks deserve these high valuations. Switching gears to FX, the pound has been notably weak. Clearly, UK economic growth has slowed. Last week, we saw the second iteration of Q2 GDP was unchanged at 0.3%. That's down from 0.6% in Q1. And arguably, business confidence is starting to get hit a little bit by Brexit. But I think a lot of what's causing this weakness in the pound is outside factors. So the euro has been bid up by forecasts the ECB will back off from QE, as we've been talking about for a long time. And the dollar is bouncing back from a rough run in the last 6 months. So if those outside factors change, so will the direction of sterling, in my opinion. And before we wind things up here, gold has been looking strong again, but that 1,300 mark is still really solid resistance. I've talked about the effect of the dollar, QE, etc. umpteen times, so I'm not going to do it this time. One thing I alluded to in a piece that I put on the internet earlier in the year is that September and October are seasonally strong for gold. And so that coincides with these German elections, and we've seen a bit of a bid up for gold during recent elections. So that's a couple of justifications to consider a potential for a breakout higher. Thank you very much for watching. Good luck with trading this week. And don't forget to follow LCG on social media to get all the latest research.